Hi everybody, it's AJ speaking. This is part 13 of my Tesla 4Q 2024 financial review. Here is a chart I showed in the prior part, but it's good to look at it quickly again. We move on to inventories. As you can see, this was a major driver of operating cash flow in a positive sense, contributed 2.2 billion compared to the third quarter. And here you can see the sort of the main reason. This is the balance sheet inventory amount, and you can see that sequentially this came down by 2.3 billion. This is like a 16% decrease, 10% decrease year on year, and ending the December with $12.3 billion in inventory. Please note this includes both Auto and Tesla's energy business, and all else really, also potentially parts and components in other areas of Tesla's business. So, and when you look at this, you should also note that this is actually the lowest level since the third quarter of 2022. So Tesla really keeps tight inventory. So this is very positive. This speaks to the efficiency of the business. Then on this slide, you can see sort of the key driver. So this slide shows you the days of supply in the automotive business. And days of supply means if Tesla stopped production right now, for how many days could Tesla keep selling product? And this is what days of supply shows you. Tesla reported for December 2024 that there would be only 12 days. So if Tesla stopped global production, they could sell for 12 days vehicles, and then all inventory would be gone globally. And here on the right hand side, I show you the calculation. You take the number of vehicles in inventory and you divide it by the number of vehicles delivered, and you have to pick the right period, which is a quarter, and then you apply it with the number of selling days in the same period. So you have to make sure these two are consistent, and there are different ways how you can calculate DOS. Some companies, they use for each quarter the actual selling days. This is typically done when you have a DOS calculation for a specific country, because there you can typically calculate it exactly. But on a global basis, typically what people do, they use a convention, because different countries, different regions have different number of selling days, because they have different kinds of holidays, etc. And so therefore, for example, Tesla is using this convention 75 days, and this is also aligned with Automotive News, which has been reporting these numbers for a long time. So then when we look at this chart, so 12 is the number of days of supply, and then the 79,000 here in this turquoise colored circle, 79,000 shows you the inventory, and you can see this has come down quite a bit. So we had record inventory in the first quarter, and we discussed why. There were various logistical and other issues in the first quarter that led to Tesla being unable to deliver a lot of vehicles. Then you can see here in this rectangular box, you can see the delta between deliveries and production. And in the first quarter, there were significantly more deliveries than production, and so the production shortfall was 36,000 vehicles. This was obviously planned, as we discussed earlier. And in the prior quarter, Tesla built a little bit of inventory. And in second quarter, there was also a significant inventory drawdown, as one would expect. After a significant spike of 1Q, Tesla sold down many of the vehicles that could not be delivered. And then there was sort of a normalization in the third quarter, and now we had this significant drop, which is probably below where Tesla wants to be to make sure quick availability of vehicles. So my expectation is that once things normalized, 1Q will be most likely quite messy because of the transition of the main product, Model Y. But once things normalize, I expect this to happen in 2Q. We will likely see some increase in days of supply as Tesla sort of tries to saturate its vehicles in inventory to make sure customers have quick access to vehicles. So on this next chart, we look at how the change in in inventory actually affected the operating cash flow, and this is what this chart shows. There was a significant over 2 billion positive effect after a slight inventory increase in 3Q had a modest 200 million negative cash impact. And just to make sure everybody's on the same page, when inventory goes up, Tesla obviously had to pay for the inventory. There was a cash out, and because it's in inventory and hasn't been sold, it absorbs capital, so it's cash flow negative. But then conversely, as you sell off inventory, it releases the capital that is bound in the inventory, and that's why it's a cash flow positive. And this is what this chart shows you. For example, in end of 2021 and 2022. Into 2023, Tesla kept increasing inventory for various reasons, to maximize sales, but also because the demand shortage started to kick in, and Tesla tried to find the optimum between discounts and inventory availability, etc., till they found kind of sort of an equilibrium in the second half of 2023. And then issues in 1Q threw a wrench into all of that, and that's why you then saw significant volatility in 2024. Now we look at the inventory balance on the balance sheet again, so it's the same number you looked at before, but this time split into auto and energy and storage. And you can see that both main segments saw a sequential decrease. So this number shows you the sequential increase in auto. So auto contributed 2 billion, and we just discussed what the driver was the sell down of a vehicle inventory. But also interesting to note, the energy business, its inventory also declined, and this is part conjecture, but also part of sort of interpretation of these numbers. Because when you look at these inventories, what you notice is, at least in 2024, the inventory lows coincided with peak deployment recognition. So in 2024, the two peaks were the all-time high in the fourth quarter, and you can see we have now almost long-term low inventory in the fourth quarter, and the same happened in the second quarter. Tesla had a significant spike in deliveries, and this dropped inventory to a low, and this gives kind of a numerical clue. Is it realistic that inventory drops further than energy storage? I don't think so. I expect this number to increase, and also based on what the CFO said, I expect that in the first quarter Tesla will be actually deploying less energy storage. So my assessment is based, first of all, of course, what the CFO indicated, but also just basically based on these numerical trends that I can see here in the inventory. And it kind of makes sense. Tesla has to produce products, sends them out. These large energy products take a long time for recognition, so before Tesla can recognize them, it has to put these products somewhere in their financial statements, and the place to put them is in the finished goods category, which is part of the inventory balance. And that's why this is an item as an investor you should look out for when you see a meaningful increase in this energy segment inventory. This is kind of an early clue that good things are to come. Because keep in mind, Tesla stated they're still kind of production constrained, not demand constrained. So as you see an increase in inventory, that should translate in meaningful revenue recognition 1 quarter later probably. So on this chart, we yet again look at inventory balance on the balance sheet, same numbers as you looked at before, but this time not split into auto and energy. Here you see it's split into the different categories. There are 4 main categories. Let's start with the biggest one, which is in fourth quarter, raw materials, 5.2 billion in raw materials, which came down sequentially. Second one, which is often the biggest one, is finished goods, and this came down significantly, obviously, because Tesla reduced vehicle inventory. And then you have work in progress. Work in progress basically stayed the same sequentially, and then you have service parts as an item. As you can see from a long-term trend, it tends to increase, which also makes sense because Tesla's global vehicle fleet is increasing. This means that there will be more repairs and spare parts that are being needed, etc. So over time, you also expect this item to increase. But as you can see, this is a smallish contributor. So with that, we reached the end of part 13. In the next part, we'll be discussing depreciation and other important cash flow drivers. See you later. Bye.